Welcome to the deep dive. Today, we've got something really specific planned, aimed right at you.
That's right.
If you're an ACCA student, knee-deep in prep for the financial reporting exam, the FR paper, and you wanted a revision session on Chapter 6, well, you're in exactly the right spot.
Absolutely. We're going to take apart the key stuff for this chapter. We'll be using the official ACCA financial reporting syllabus and study guide the one for September 2025 to June 2026.
And we've also got that helpful visual overview for Chapter 6 they provide.
Yep, using that too. Our mission today, to really unpack the accounting for inventories and biological assets, we want you to get the concepts, the requirements, basically feel ready for this part of the exam.
Right, not just listing things, but getting into the why and the how.
Exactly. So Chapter 6, like the visual overview says, and it kind of bundles together two things, inventories and biological assets.
They sound pretty different.
They are, in many ways.
Ah.
But the chapter looks at the accounting treatment for both and how they end up, affecting the financial statements.
Okay, so let's kick off with inventories. Probably the one most businesses deal with day to day. The guides point us to IAS 2 inventories. What's the core idea there?
Well, IAS 2 is all about how you value and account for inventory. An inventory is basically assets a company has to sell in its normal business, like finished goods.
Stuff on the shelves?
Exactly. Or things being made work in progress. Or even the raw materials and supplies you use up to make the goods or provide services.
Gotcha. So tracking the value of all that stuff. Now, the visual overview lists a few key things under inventories: measurement, cost, costing methods, cost formulae, net realizable value, and recognition. That seems like quite a bit.
It is, but it all fits together. The absolute #1 rule, the fundamental measurement principle in IAS 2 is this. Inventories have to be measured at the lower of cost and net realizable value.
Lower of cost and NRV. Okay.
Let's remember that one. It's driven by conservatism, really. You don't want to overstate your assets.
Right, conservatism. Okay, so let's break down cost. What actually goes into the cost of inventory?
Good question. Cost includes pretty much all the costs you incur to get the inventory to where it is now and in its current condition.
So like the purchase price.
Purchase price, yes. Plus import duties, transport costs, but minus any trade discounts you got. Then there are costs of conversion. That's things like direct labor and a share of the factory overheads needed to turn raw materials into finished goods.
Okay.
And any other costs that were necessary to get the inventory ready was not included. Things like abnormal amounts of waste, most storage costs.
Unless storage is part of production, maybe?
Exactly, like maturing whiskey or something. Also excluded are general admin overheads that aren't related to production and selling costs. Those come later.
Okay, that makes sense. It's really about the costs directly tied to getting it ready. Then we hit costing methods and cost formula. This sounds like how we figure out costs when prices change, right?
Spot on. If you buy or make inventory at different prices over time, which, let's face it, usually happens.
Yeah, inflation.
Right. So when you sell some, you need a consistent way to decide which cost attaches to the items sold that goes to cost of goods sold, and which cost stays with the items you still have that's your closing inventory.
And IAS 2 allow.
For items that are interchangeable, IAS 2 basically allows two main cost formulae: FIFO, first in, first out, and weighted average cost.
FIFO. That assumes the first stuff you bought is the first stuff you sell.
Yeah. So your closing inventory, the stuff left over, is valued at the most recent costs.
Which means if prices are rising.
Prices are rising, FIFO gives you a lower cost of goods sold because you're expensing the older, cheaper costs, and higher closing inventory value because it's reflecting the newer, higher costs.
Okay, and weighted average.
That one's different.
Yeah.
You calculate an average cost for everything you had available during the period. You might do it periodically or after each new batch comes in.
A running average?
Could be, yeah, depends on the system. But you use that average cost to value both the items you sold and the items left in inventory. Kind of smooths things out.
So if prices are rising, weighted average would give results somewhere in between FIFO.
Exactly. It blends the costs. Now, here's a really important point. IAS 2 explicitly bans the LIFO method, last in, first out.
Oh, right. LIFO is out for IFRS. Why's that?
Well, there are a couple of reasons. One argument is that LIFO often doesn't match the actual physical flow of goods for many businesses. Plus, it can result in your closing inventory being valued at really old, possibly irrelevant historical costs on the balance sheet.
Okay, that's a key exam detail. No FIFO and weighted average are okay. LIFO is not.
Got it.
Yeah.
Let's talk net realizable value, NRV. That's the other half of the lower of cost and NRV rule.
Right. NRV is your best estimate of the selling price you'd get in the normal course of business.
What you think you can sell it for.
Yeah, minus any estimated costs you still need to incur to finish the item if it's work in progress.
Okay.
And minus the estimated costs you'll have to pay to actually make the sale, like delivery costs or sales commission. So it's the net amount you expect to actually get in your pocket from selling it as it is or after finishing it.
Pretty much. And this is crucial. You compare this NRV to the costs you calculated using FIFO or weighted average.
Yeah.
If the NRV is lower than the cost,
You have to write it down.
you have to write the inventory down to its NRV. That difference, that loss, hits your profit or loss statement, usually within cost of goods sold. Think about old stock, damaged items, or products where the market price has just crashed.
You can't keep showing it at a high cost if you know you won't get that money back.
Exactly. It's about not overstating assets. And finally, recognition. When does inventory cost hit the income statement as an expense?
When you sell it.
When you sell it. The carrying amount of the inventory sold is recognized as an expense. Cost of goods sold in the same period that the related revenue is recognized. Cost follows revenue.
Okay. Now, linking this back to the study guide, Section B4A says you need to describe and apply the principles of inventory's valuation. We've just described them.
And the key word is apply. It's intellectual level 2 application and analysis. You won't just be asked for definitions.
So more like calculations.
Definitely. Expect scenarios. You might get data on purchases, production costs, estimated selling prices, selling costs, and you'll need to calculate the closing inventory value. You'll have to choose FIFO or weighted average, figure out the cost, figure out the NRV, apply the lower of rule, and maybe even explain why you did a write-down. You have to use the rules.
Okay, that paints a clear picture for inventories. Now, the other part of Chapter 6, biological assets, this feels quite different. IAS 41 agriculture, the guides say.
Yeah, this standard is quite specialized. It covers accounting for living animals and plants, biological assets, but only when they're part of agricultural activity.
Agricultural activity. What does that mean specifically?
It's defined as managing the biological transformation.
Biological transformation.
Yeah, the processes of growth, degeneration, production like wool or milk, and procreation, basically managing how these living things change, grow, and produce with the aim of selling them or their produce or making more biological assets.
So it's about the living, changing nature of these assets. The visual overview mentions terminology here too, some key terms we need.
Definitely. You've got the biological assets themselves, think sheep, cattle, trees, and a plantation. Then there's agricultural produce, that's the harvested product. Wool from the sheep, logs from the trees, apples from the orchard.
Okay.
Harvest is the point you detach the produce or, end the asset's life. And that term biological transformation is central. It explains why these assets need special accounting rules.
Right, because they grow and change on their own, unlike a machine. Okay, so recognition and measurement for these.
Recognition is fairly standard asset stuff. You recognize it if you control it from past events. Future economic benefits are probable. And here's the key bit. Its fair value or cost can be measured reliably.
Fair value or cost. That hints at the measurement difference. How are they usually measured?
This is the big shift from historical cost accounting. Under IAS 41, biological assets are generally measured, both when you first recognize them and at the end of every reporting period at their fair value, less cost to sell.
Fair value, less cost to sell. Wow, okay. Not cost.
Generally, no. Fair value is basically the market price. What you could sell that cow or tree for right now in an active market. Costs to sell are the direct costs of selling, like auction fees or transport to market.
Why fair value? Why not stick with costs like other assets?
It comes back to that biological transformation. These assets are constantly changing in value because they're growing or aging, or maybe market prices for livestock are fluctuating wildly. Historical costs just wouldn't capture that current reality.
So fair value aims to be more relevant.
That's the idea. It shows the economic effects of the growth and market changes as they happen. So if your vineyard's grapes plump up or the price of beef goes up, the fair value of your vines or cattle increases.
And that increase, where does it go? Straight to profit.
Yes. Any gain or loss, when you first measure it at fair value, less costs to sell. And crucially, any gain or loss from changes in that fair value, less costs to sell each period, goes directly into profit or loss for that period.
Whoa, so profit could jump around quite a bit depending on growth or market prices.
Absolutely. It makes the profit figure potentially more volatile compared to using historical cost because it reflects these unrealized value changes immediately.
That's a really significant difference. What about the agricultural produce, the wool, the logs, the apples?
Right, the harvested stuff. That's measured at its fair value, less cost to sell, but specifically at the point of harvest.
Okay, so when it's picked or shorn or felled.
Exactly. And then once it's harvested, it falls under IAS 2 inventories. That fair value at harvest effectively becomes its initial cost for inventory purposes. From then on, it's lower of that cost, and NRV, just like regular inventory.
Ah, so there's the link back. IAS 41 hands over to IAS 2 at the point of harvest. Interesting. And the study guide, B4B, says, apply the requirements for biological assets and agricultural produce.
Yeah, again, level 2 application. You need to be able to do the calculations. For instance, they might give you info on a herd of dairy cows, changes in fair value because they got older, maybe some had calves, milk prices changed. You need to calculate the closing value and the gain or loss hitting the P&L. Sometimes they even ask you to split that gain between physical changes and price changes.
Right, more number crunching needed. Okay, so we've got IAS 2 for inventory, IAS 41 for biological assets. The visual overview also flags disclosure for inventories.
Yeah, disclosure is important for both, really. Even though the measurement rules are different, they both end up as assets on the balance sheet. Users need to understand what's behind those numbers.
So for inventories.
IAS 2 says you need to disclose the accounting policies, like did you use FIFO or weighted average. You need to show the total carrying amount, often broken down by category raw materials, WIP, finished goods. And any write-downs to NRV need disclosing too.
And for biological assets, similar idea.
Similar idea, yes, but IAS 41 has its own specific, quite detailed disclosure requirements. Things like describing the assets, the nature of the farming activities, a reconciliation showing how the carrying amount changed during the year, separating out physical changes and price changes is encouraged.
Okay, so transparency is key for both. Let's zoom out again. Where does all this Chapter 6 stuff sit in the big picture of the FR syllabus?
It's right there in Section B, which is called Accounting for Transactions in Financial Statements.
Makes sense. These are core operational transactions.
Buying, making, selling inventory, growing and harvesting biological assets. Yep, right at the heart of operations for many businesses.
And how might this actually appear in the FR exam? What's the likely format?
Well, like we said, the calculations, inventory valuation, NRV write-downs, biological asset fair value changes, those are perfect for the objective test questions, the OTQs in sections A and B.
Quick tests of applying a rule.
Exactly. Short, focused questions. But don't assume that's it. This stuff is fundamental. It can easily be woven into the bigger 20-mark constructed response questions in Section C.
How so?
Imagine a Section C question about preparing financial statements for a manufacturer. Inventory is going to be a big part of that. Or a scenario about a large farming group, you'll definitely have biological assets and agricultural produce to deal with. You might need to calculate the values and slot them correctly into the statement of financial position or profit or loss.
So you need both the detailed calculation skill and the ability to see where it fits in the overall statements. The syllabus also notes FR builds on financial accounting, FA.
It does. You'd have seen basic inventory in FA, probably FIFO and weighted average definition, but FR demands more depth. Really understanding why costs are included or excluded, mastering that lower of cost and NRV application, dealing with more complex scenarios. And IAS 41 is likely brand new territory compared to FA, so getting your head around fair value, less cost to sell is critical.
And we shouldn't forget the exam format itself, the digital skills aspect.
Oh, absolutely vital. It's a computer-based exam. You'll need to use the spreadsheet tool for your calculations, especially in Section C, and the word processor for any explanations or disclosure notes required. Practice these Chapter 6 topics using the exam software is really important. Get comfortable with the tools.
So wrapping up, why is getting Chapter 6 right so crucial for FR students?
Well, fundamentally, because almost every company has some kind of inventory. And for agriculture, forestry, fishing biological assets are their main game. These often represent huge values on the balance sheet.
And the accounting rules directly impact profit.
Hugely. Getting the difference between IAS 2's lower of cost NRV approach and IAS 41's fair value less costs to sell is non-negotiable. And understanding the reasons behind those different rules that's moving into that application and analysis level the exam demands.
It helps you interpret the numbers too, not just calculate them.
Exactly. Knowing how inventory or biological assets are valued tells you something about the potential volatility and reliability of reported profits and assets.
Okay, so a really thorough deep dive there into Chapter 6. We've hit inventories with IAS 2 cost, NRV, FIFO, weighted average, and biological assets with IAS 41 fair value transformation harvest, plus disclosure and how it fits in the exam.
We've tried to pull out the core things from the study guide and overview for you.
Definitely. So for your own revision now, really dig into those learning outcomes, B4A and B4B in the detailed guide. Try applying the rules. Sketch out mini scenarios for different business types. Practice those calculations.
Yeah, the more you apply it, the better it sticks. And maybe one final thought to chew on as you revise. We talked about inventory being at lower of cost NRV, and biological assets at fair value, less cost to sell. Think about that impact on profit. Inventory write-downs usually happen when value is lost, but fair value changes for biological assets hit profit constantly, up or down, reflecting growth or market moves, even before a sale.
Interesting point.
So how might that difference in measurement affect how someone, say, an investor, looks at the earnings? Would they see earnings from a retailer as more stable, maybe, than earnings from a farming company, purely because of these accounting rules? Something to think about.
Definitely food for thought. Okay, that's us for this deep dive on FR Chapter 6. Best of luck with your studies.